In today's video, we're going to look at a case study for a couple in their 50s that want to retire by age 60. They want to retire while they still have good health, while they can travel, and make the most of their retirement years, doing things that they missed out on while having their heads down working for their entire lives. Their main concerns are having financial security early in retirement and not running out of money later in life, becoming a financial strain and burden on their family, or making big financial mistakes to put their whole retirement in jeopardy. Don't forget to watch till the very end, because I'm going to cover some specific investment strategies to help you create financial security for yourself and provide a legacy for your family. So without any further ado, let's get right into this video. Now, before we jump into this video, I gotta cover something pretty important. You'll notice today I'm not wearing my glasses. I was talking with a client last week who noticed that in one of my recent videos, I was not wearing my glasses, and they wondered if I'm now a big hotshot and I wear contacts. And the truth is, I just forgot to bring my glasses to the office. So if you find me squinting at the screen a little bit, it's because, yes, I do need glasses. And no, I don't have them. I forgot them. So we're gonna do our very best today.
I feel like I'm just flying blind.
In this video, we're going to revisit one of our old case studies looking at Candace and Tucker, who are 50 years old and they want to retire by age 60. And what I want to focus on in this video is looking at the whole concept of providing financial security whilst providing the ability to have inflation-adjusted income for the rest of your life. It's a major concern, and frankly, for most people, I'd say this is at the top of their list, is making sure they don't run out of money in retirement. So let's get right into the details of their financial situation, and then look at some of the strategies that we've used to address the concerns that they have. So Candace and Tucker, at this point in time, they're working, they recently paid off their home, they're 50 years old, and they have the target of retiring at age 60. Up to this point, they've saved about $500,000 for retirement. Most of that is in their 401k plans, and they started saving a little bit into a brokerage account. So now, while we have these 10 years between their current age and when they retire, we want to look at strategies they can use in order to get themselves in a good financial position to retire at age 60. So first, before we get into the details of exactly what they would do, I'm going to talk in some very specifics about investment strategies, about how to create financial security. But let's look at where they're at, the projections for age 60. So I'm going to click over to a dashboard of their retirement plan. So between age 50 and 60, that 10-year period of time, what they're doing is continuing to save into their 401k plan, getting that employer match, and I'm having them save extra money. What they would have been doing into their, paying on their mortgage, it was about $2,000 a month. I'm going to have them set that aside into a brokerage account, some after-tax savings that they'll be able to access early on in retirement. And this is very important, not the main topic of this particular video, but it's really to facilitate them having money they can access where they can on paper show a low tax liability and qualify for affordable health insurance early on in retirement. Now, as you can see from this projection on the screen, they would have about $2 million given some very moderate return assessments. And based off of this, we've created a plan for them to have about $9,500 a month, inflation adjusted, for the rest of their life. I also, important to note, as part of this plan, one of their main concerns is becoming a financial strain, for their family, maybe having to move in with their kids or something like that in the future to take care of them. And so we also built into the plan that by the time they, pass away, let's call it 35, 40 years, however long that they might live, that they would still have about $2 million in their portfolio. And not that they want to die with a bunch of money. They're okay leaving money behind, for their kids and grandkids, that sort of thing. But really the main objective for planning on not spending the account down to absolutely zero is so that if there are some extra expenses later on in life, like long-term care issues or something like that, they've got, they still have a nest egg they could dip into more aggressively in order to provide that shortfall. Now, for this video, we're talking all about financial security in retirement. And for Candace and Tucker, one of the things that they've considered is, should we buy an annuity that would provide us some guaranteed income, regardless of what's happening with the market. They don't have a pension, and so really they're just looking at what they can save between now and retirement, what they've already saved, and then of course their Social Security benefits. Now, lucky for them, they've both been working, they both have a good earnings history, and so this is a very strong point of their plan, is that they have a dual income household with 2 Social Security benefits, so we can look at different strategies for them for claiming Social Security to provide a good base amount of income. When it comes to providing guaranteed or, financial security in retirement, I think really the pinnacle for financial security in retirement is being able to maximize your Social Security benefit. Frankly, with all the, concerns that are out there, and I think reasonably so, people are concerned about Social Security benefits and, are they going to be there, et cetera. I think that we should plan on them being there. And my basis for that is that we face situations in the past that are similar to the present, where the Social Security system was being financially strained, and through very simple tax policy changes and kind of benefit structure changes, the plan was financial security was gained in the program. And frankly, those changes, when they were made in the past, they didn't impact people who were close to retirement. It really just impacted people who were younger. And so I think that's a safe assumption. Obviously, not knowing the future, that's the assumption that I would use with this client. So when it comes to providing financial security, any time that we can figure out a claiming strategy with Social Security that will cover someone's, base kind of minimum amount that they need to just cover their living expenses, all of a sudden that provides a very strong, guaranteed income floor. So what I mean by this, just, practically speaking, is let's say that Candace and Tucker, they need something like, I don't know, $7,000 a month is kind of like, hey, we want to retire and have at least $7,000 a month to cover our living expenses, be able to have money for travel or anything. Anything above that is nice, but we don't necessarily need it. So if we can figure out a way to claim Social Security where that amount of, baseline income is going to be covered by Social Security alone, then we're in an extremely solid place for Social Security. Now, for most people, they're not going to be able to achieve that by claiming Social Security early, right? If you claim your Social Security early, all of a sudden you're in a situation where your Social Security benefit is going to be lower and you're going to have a harder time covering those base retirement expenses. So usually what this means is that someone's retirement plan is going to look like in the early years, we're drawing on the portfolio a little bit heavier. We're taking a larger distribution rate that probably would not be sustainable if you planned on doing it for the entire length of your retirement plan. However, if we plan on the future, Social Security to kick in and it's going to cover the lion's share of your spending needs, that will allow you essentially to take more out of your portfolio in the beginning years of retirement, and then in the back half of your retirement, you don't need to draw as heavily on your portfolio, or it's frankly totally discretionary. Like you can draw from the portfolio, but you don't have to. So let's look at that income chart to show you what I'm talking about here. So on this cash flow chart, essentially what we're doing is we're looking over time, where is their income coming from? So today they're not retired. We're fast forwarding 10 years to age 60. And along the bottom, we're looking at the years, in retirement. And along the y-axis here, we're looking at monthly income. So you can see that this yellow here represents taking money out of the portfolio. Now, you saw on the previous screen that their net monthly income was about $9,500 a month. This is showing a gross income number, right? We have to account for some taxes, et cetera. So it's almost $11,000 a month that we're taking from the portfolio. So as we go through retirement, you can see that early on, 100% of their cash flow is coming from the portfolio. Now, once we get along to age 62, we're actually going to have Candace claim her Social Security at age 62. Now, this is a strategy that often works well for a dual income household where the husband and wife both have a Social Security benefit, is for the lower earning spouse to claim their benefit early and allow the higher earning spouse with the larger benefit to delay their benefit until at least full retirement age or even beyond till age 70, which is what we happen to be doing in this video with Tucker. So Candace claims her benefit at age 62, and you can see that once that happens, the draw on the portfolio goes from being about $11,000 a month down to $8,800. So if you look at a total portfolio of just over $2 million, we went from something like a 6%, distribution rate. Now we're down to something like a 4.5% distribution rate. As we go along, you can see that several years at about that pace, and then once Tucker hits 70, he claims Social Security, and so now they're bringing in from Tucker's benefit about $6,700 from Social Security and about $3,200 a month from Candace's benefit. Now, what they need to draw from the portfolio to just meet their desired retirement income is a lot less. So now it's a very, very small percentage of the overall portfolio, something more like 1.5%, a 1.5% distribution rate. Now, I know what you might be thinking. You're looking at these benefits and you're saying to yourself, I've never seen a Social Security benefit for $6,700 a month. What the heck are you talking about? The reason for this is that this couple is only 50 years old today. We're looking out into the future, 10 years before they even retire, and then for Tucker specifically, another 10 years before he claims his benefit. And whenever you look at a Social Security projection, whether you look at your statement that you get in the mail or you log into ssa.gov to look at your projected benefit, those benefit estimates for 62, 65, 67, 70, those estimates do not include a cost of living adjustment. And so what we're doing here is we're actually factoring that in because that's what's most realistic. The cost of living adjustment with Social Security is just part of the law. It's baked in. It happens automatically every year. And having worked in the profession for a long time, I've seen this with my actual clients every year, seeing them get their cost of living adjustment. So we're going to actually plan for that. And that's why that benefit is so long, because we're basically looking at cost of living adjustments for 20 years in this case. And that's why that number is higher than what you've probably seen. Okay, so now once they reach this point, you can see that them drawing from the portfolio, this yellow bar just gets ever and ever smaller as their Social Security income just continues to grow. And so you'll notice here at this point in time, basically their portfolio withdrawals end up going to zero. Now, that is not because they've run out of money. That is because we have optimized this plan to target, $9,500 a month net income adjusted for inflation over time. And eventually their Social Security benefits alone fully cover that. In fact, they cover it in excess of that amount. And so that's why the portfolio withdrawal is kind of trailing off to zero, not because they've run out of money. This is very powerful because at this point, they can take extra money out of their portfolio, but it's completely discretionary. So if they want to do something extra, if they want to do extra travel or, help a family member, whatever it is they want to do with their money, they can absolutely do it. And they can draw from that portfolio as they would like, without jeopardizing the financial security of their retirement, because their needs are totally covered by that inflation-adjusted, tax-efficient, guaranteed income source of Social Security. There's a lot of benefits by doing that. So the real issue that people run into with creating a retirement plan like this is, okay, how do I structure my investments up front, knowing that, okay, probably in the beginning of my retirement, I'm going to have to draw heavily on my portfolio in order to cover my cash flow needs early in retirement. So how do we do this? Talking to, frankly, most financial professionals out there, this is where you end up getting the sales pitch for doing something like buying an annuity. Because, hey, if you buy an annuity, you're going to get this guaranteed income, blah, blah, blah. And I'll tell you that 99 times out of 100, that's just a bunch of malarkey. You don't have to go in and buy some complicated, expensive, penalty-infused, fee-ridden financial product like an annuity in order to provide safe, guaranteed money in retirement. Guess what? You can actually invest in the most simple thing available to be able to provide that for you. So from an investment approach, how to manage kind of this risk issue of needing to provide financial stability early in retirement whilst providing the ability for the portfolio to grow, for the back half of retirement, so there's extra money to access, especially in the event of long-term care needs. So I'm going to pull up a little chart here that I think you're going to enjoy. So we're back with my friends, our good friends over at JP Morgan. I don't work with them. I don't get anything from them, but they put together these really good charts that are just super helpful. And I think anybody, if you just access this stuff, Guide to Retirement, you can download these PDFs that are available online, available to the public, just good educational information. So on this chart, what we're looking at are different investment strategies that are best appropriate for different time frames. At the top of the screen, we have, I think you can see my cursor here. This green represents investing in cash. Now, I throw around the term cash as a very broad and loose term, but really what I'm talking about here is investing in like short-term government treasuries, 90-day T-bills. And the great thing about investing in this, the most simple of financial investments or instruments, is that it's 100% guaranteed, backed by the full faith and credit of the United States. It pays guaranteed interest. You can redeem it at any time. There's no penalties or fees or anything like that. It's the simplest, most straightforward investment. Now, the next one here is a portfolio of a mix of stocks and bonds. And you see this term equities. Equities is a term in finance that we use to talk about stocks. Equity means ownership, and when you own stocks, you have a small ownership stake in a company. So equities, stocks. And then this little diagram here is the same thing. Stocks and bonds mixed together, but more stocks. Okay, now let's look at the bottom half of this chart. We're looking at a time frame from 1950 up through 2024. And what this is showing us is that over different time frames, what has been the max and the minimum return for this these different investment mixes over time. So the first chart, the first part let's look at here is over a 1-year time frame. And let's see if I can zoom in a little bit here so we can get a better look at that. Okay, so what this is showing us is investing in, again, blue equities, bonds, half and half, and then cash. And what have been all the different returns that somebody would have had, different 1-year returns investing in those mixes. You can see that stocks are kind of what you would have expected. Now we're looking at 75 years of 75 investment years, and there's been a year where you would have made 52%, a year you would have lost 37%, and everything in between. Now when it comes to bonds, your upside was less, 33% in the very best year, with less downside, minus 13. Now a mix of stocks and bonds, you can see that over any given 1-year period of time, your best 1-year return for a 50-50 portfolio of stocks and bonds was 29%, with the worst year being negative 16%. Now let's look at good old faithful US Treasuries cash. Your best year, this 14%, that was probably under early Reagan administration, under the Paul Volcker Federal Reserve regime, where he hiked interest rates up very high to try and combat inflation.
Always felt, as you well know, that getting the economy on a sustainable growth path goes hand in hand with the necessity for financial stability and a non-inflationary path. And in the most general terms, it's the job of the Federal Reserve and the job of all of us to take the actions that are necessary to achieve that.
You could have, there were times when interest rates were really this high, believe it or not, but 14%. And your worst year was 0%. You didn't lose anything, you earned 0. Okay, so over a 1-year period of time, if you needed money in 1 year, what would be, drumroll, what would be the most appropriate or the best investment, available for that? Well, when I look at this chart and I said, if I need money absolutely guaranteed no matter what, I can't risk losing any of it, which is the best investment for a 1-year strategy for a 1-year period of time? It looks like the winner is cash. Okay, if you invested in anything else for money you're going to need in a year, it's very possible. In fact, frankly, it's more likely than not that it would have been positive. But there are plenty of times when it would not have been positive and you would have been sorely disappointed having, needing money a year from now and finding that it dropped, pretty significantly. Now let's look out over longer time frames. So over any given 5-year period of time, over this time frame, what were the results? Your best 5-year annualized return was plus 29% per year in stocks, with a negative 2% per year, over 5 years. Same thing for bonds, negative 2 for 5 years per year, but a plus 18, a 50-50 mix. Now this is interesting. We see the power of diversification, where stocks alone, negative 2% per year, bonds alone, negative 2% per year. But when you mix them together, all of a sudden your worst 5-year rate of return that you would have had, the very worst one, was a plus 2% per year over that time frame. Okay, now we come to cash, 0 and 11%. Okay, not bad. Okay, let's skip all the way out here to 20 years. Okay, now this is where things really shine. Your worst rate of return per year in stocks from 1950 up through 2024 would have been 6% per year. All right, let's look at the extreme here, because these two are kind of in the middle. Let's look at cash. Your worst rate of return over 20 years would have been 1%, and your best would have been 8% per year in cash. This really gives us bookmarks of what is the ideal type of investment that you're going to need in the short term versus over the long term. There are good and bad investments, but oftentimes it's just the right investment for the right mission. And the mission is, when do I need to access this money? If I need the money in a year from now, okay. If I invest in anything besides basically cash, effectively, I'm kind of gambling. I'm kind of rolling the dice. Could be good. Most often it has been good, but it could very easily be bad. On the flip side, if I don't need a chunk of money for 20 years from now, well, I could realistically, in fact, looking at history and what else can I do? What else can I do besides look at history?
You can never forget history, because if you forget, you never recover from it.
We have just made history!
And look at good times and bad times and see what's worked out the best and every kind of mix in between. And frankly, over long periods of time, investing in a diversified portfolio of good companies has been the clear winner, right? Like, yes, if you wanted things totally guaranteed, investing in cash would have kept things guaranteed, but then you have to deal with the effects of inflation and it wouldn't be so good. So having stocks over long periods of time, that's really the best use case for that particular investment. We don't need to get any more complicated than this. You don't need to go buy some complicated annuity with all these charts and disclosure packet this thick to be able to provide financial security. We can just use the basic ingredients, basic financial ingredients, if you will, to make a good retirement plan. So let's take this concept and flip it back over to Candace and Tucker at their actual situation to just get into kind of some practical how we would structure this. So let's roll out this chart. Let's go back. Okay, let's see here. We're going to roll this chart back and go towards, so here we are in 2025. They have 10 years before they're going to retire, okay? They already have $500,000 invested in their 401k plan. Now we know, I didn't go into a ton of detail on this, but I know, I'll just tell you. And I have another video where I kind of use the same case study, but talk about it, address some different issues. We already know that early in retirement, they're not going to be drawing from their 401k account for income. They're going to be drawing down the money that they're going to be saving up between now and then in their brokerage account. And that's for tax reasons. So between now and age 60, we've got this 10-year period of time. They've got these two accounts. First of all, their 401k. They're not going to be drawing on that. Really, they're not going to start to dip into the 401k money until really 5+ years into retirement. And so all of a sudden we go, okay, I'm not going to touch this 401k money for 15 years. Okay. So that automatically tells us, all right, within my 401k plan, where frankly, they're still making contributions, they can be invested more aggressively, mostly equities, right? You've probably all experienced this. You're working and you look at your 401k investment options, and most of you get defaulted into something that's called a target date fund. And it basically says, oh, you're age 50. Okay, this is how your investment mix should be. Or you're age 55. This is how it should be, or whatever. But frankly, what we need to do is, now that we've laid out their cash flows in their retirement plan, we know that we actually have a much clearer idea of when they're going to spend money from that account. We can actually make that investment strategy more precise. So even though they're 50, we know they're not going to be touching that account for at least 15 years. So we can invest that more aggressively than default it into just based on your age. Okay, now on the flip side, we have their brokerage account where they're going to be saving between now and their retirement in 10 years. So they've got 10 years. So we do have a lot of time frame between now and then. So the money doesn't have to be invested in 100% cash. But we know that, and like what I personally like to do is, as somebody's getting really close to retirement, I already like to set aside just a war chest of just 100% safe money, invested in, U.S. Treasuries, money market account, guaranteed, right? Because the last thing we want to do is have that bucket of money you're about to draw into. We don't want that to crash right before you're going to retire, because that can really make you go, I'm second guess this whole thing. Let's not retire. I just lost a bunch of money in my account. Okay, so between now and when they retire, I would have them invest probably half of every dollar going in. If you remember from the beginning of the video, I said they're going to put in about $2,000 a month. I'd have them put something like 1,000 of that, half of it, into just money market or short-term T-bills, something guaranteed. Doesn't need to be some fancy investment, just simple, and most of the time, simple and easy to understand is best. So half of that money is going into cash, something very safe. And then the other half, we can have half of that go into bonds and maybe half of that go into some diversified stocks. So overall, 75% of that money is in cash and bonds, and then a little bit is in stock. And that way, as they get closer to retirement, as they get closer to that age 60 date, they just have this war chest, this built up of money market that they can tap into early in retirement that is completely immune from market risk, from volatility, from any issues. Now, you might look at that and think, man, that's way too conservative to be investing. But remember, whilst their brokerage account is very conservatively invested, and for a very specific reason, because we know when we're going to tap into it, all the while, the bulk of their portfolio, this 401k, is invested more aggressively. All right, so it balances out overall. And what this will allow them to do is achieve some growth to account for inflation over time, but also kind of lock in that early retirement with a very conservative portfolio. Now, once they get later on into retirement, this is the real secret, is that once they get later on, they don't need to dig into their portfolio. So they can really do whatever they want. But what it gives them the capacity to do is invest even more aggressively in a diversified kind of equity heavy portfolio, because they can withstand the volatility. If their portfolio goes up and down and stuff, in the years it goes down, it's not as big of a deal because they're not depending on it. They can take money out if they want to, but they don't have to take money out of it. And so it allows their money, their portfolio to grow over time, and they can dip into it, as they wish, when it's advantageous and when things come up, to do extra things and fun things, and provide an incredible amount of financial stability later on in retirement. That's how we can maximize their overall investment strategy, retire early with security, and have growth for the long run. So now that you've seen how somebody can realistically create a rock solid retirement plan, you are equipped with better knowledge to make more informed and stronger financial decisions for your own life. If you'd like some help walking through the nuances, the details of your situation, go ahead and click the link in the description, and I'd be happy to meet with you one-on-one to go over your personal situation. So until next time, best of luck, have a great one, and I'll see you in the next video.